Balance sheets are an important tool for any business when it comes to financial stability and profitability. Without a proper balance sheet, businesses can quickly become insolvent, leaving them unable to pay their creditors and suppliers. Knowing how to avoid balance sheet insolvency is essential for any business owner or manager in order to ensure the longevity of their company. We'll discuss how to identify and prevent balance sheet insolvency before it happens. What is balance sheet insolvency? Balance sheet insolvency is a term used to describe a financial situation where an individual or business has more liabilities than assets. This can occur when a company has taken on too much debt and does not have enough equity to cover it. It can also occur when the value of assets decreases, making it difficult for an individual or company to pay their debts. In such cases, insolvency proceedings may be launched in order to help the individual or business get back on track. Understanding balance sheet insolvency is essential for all individuals and businesses to avoid such situations. Working out if you are insolvent is a complicated task. However, it's important to understand that while insolvency proceedings may be launched, this does not mean that the company or individual is bankrupt or out of business. In fact, going through insolvency proceedings can often result in a turnaround where the individual or business regains their financial stability sooner than it would otherwise have done. What is the difference between insolvency and bankruptcy? Bankruptcy differs from insolvency in that a person or company that is bankrupt has no assets left and is unable to pay its debts. In such cases, bankruptcy proceedings are usually launched by lenders on behalf of the individual or business. On the other hand, insolvency proceedings are used when a company's debtors can meet their obligations even if the value of its assets has decreased, so they can avoid bankruptcy, just as they would with an increase in value. What you should know about balance sheet insolvency. Balance sheet insolvency is a real concern for many businesses and individuals. It is important to take the necessary steps to ensure that you are in a position to be able to pay your debts when they come due. By taking proactive measures, you can reduce the risk of balance sheet insolvency and keep your business or personal finances in good health. Balance sheet insolvency occurs when a business or an individual is unable to pay all their expenses on time. Some examples of expenses include payroll and debt service. Balance sheet insolvency can be caused by a downturn in profits, lack of adequate liquidity, or poor management decisions. There are several risk factors that business owners should be aware of before they enter into an agreement with creditors and lenders. These risks include losses in recent investments, lack of profits in the past few quarters, a poor cash flow due to seasonal trends, an increase in demand for a product during the winter, business losses higher than the amount of available cash, high debt/leveraged position, lack of funds to pay ongoing business expenses as they come due, lack of adequate liquidity to cover business operating expenses. There are three major components comprised of a balance sheet: assets, liabilities, and owner's equity. Assets are the things a business owns that have value. They might be cash in the bank or buildings on the property. Liabilities represent what a business owes to others. Accounts payable and interest owed on loans outstanding are examples of liabilities you should keep track of. Owner's equity is the difference between assets and liabilities. It's what's left over after everything is paid off. The assets of a company are the items it owns that have value, such as cash on hand or products in inventory. Liabilities are the obligations a company owes to others, such as accounts payable and interest owed on loans. The owner's equity is what's left over after liabilities have been subtracted from assets. It's what's left over after everything has been paid off. What you can do if your company's balance sheet is insolvent. Insolvency is a financial position where a company's liabilities exceed its assets, making it unable to pay its bills. If your company finds itself in an insolvent situation, there are certain steps you can take to try to mitigate the impact and protect your business. This includes taking steps such as restructuring debt and negotiating with creditors, seeking financial advice from accountants or insolvency practitioners, exploring formal insolvency processes such as voluntary administration or liquidation, or even pursuing legal action against directors of the company. The way forward depends on the particulars of each situation, so it is important to seek professional advice before making any decisions. A company may be declared insolvent if it has no reasonable prospect of survival, or a company and its directors have knowingly made decisions that will lead to the company becoming insolvent. In order for a company to be declared insolvent after bankruptcy, it must not have any assets left over at the time of bankruptcy, in contrast to liquidation, where the assets are auctioned off and distributed to the company's creditors. Legal recourse. If a company's directors and officers have knowingly made decisions that will lead to the company becoming insolvent, it may be possible for shareholders to sue for damages, including loss of investment. How to test for cash flow insolvency. Cash flow insolvency is a situation in which a company's liabilities exceed its assets, leading to the inability to pay off debts. It is important for businesses to regularly test for cash flow insolvency in order to identify any potential risks and take measures to avoid them. Testing for cash flow insolvency involves analyzing the current financial state of the business, assessing its ability to generate liquid funds, and understanding the long-term impact of its current decisions on future cash flows. The process of testing for cash flow insolvency also involves assessing the company's long-term growth potential, as well as its position in the market. Testing for cash flow insolvency can be a useful tool in evaluating whether a business is fully funded to continue operations and provide it with an opportunity to negotiate favorable terms of transactions that would benefit the business. There are several indicators that may suggest the company is entering into cash flow insolvency. These include increasing debt, insolvency in its current debts, low liquidity, and high investment capital requirements. It is important to understand the operational implications of such a situation before taking any action, as it could have a knock-on effect on the entire operation. For example, if a business has extensive long-term liabilities and has already exhausted its liquid funds in order to meet them, it will not be able to undertake further investments or pay off current obligations on time. Consequently, this business may need to consider restructuring its long-term liabilities or taking on additional long-term debt. The loan. Alternatively, if the business has liquid funds available and its current obligations are not burdensome, it can meet its demands with investments or pay off other obligations. In this case, the business will not need to consider restructuring its long-term liabilities or taking on additional long-term debt. Thank you for watching.